Hi everyone, this is Rohit Srivastav and I welcome you to an introduction to algo trading. There's a very small presentation that we'll be going through to just understand what algo trading is all about. It is basically for people who are new to algo trading and just want to understand how it is done and what are the various kind of algo trades that I execute in the market. So for those who are already advanced users, they might very well, or rather not advanced users, know what algo trading is all about. They can very well skip this, but for others, let's begin. So what is algo trading? People have this uh, belief that algo trading is something very complicated, very complex, and involves tons of rules that are there, tons of data crunching, etc., which is done and very complicated to create. In some cases, that is definitely true, but in most of the cases that are there, algorithmic trading are actually simple trading strategies that people use, which are coded into a specific language and then run as a system, and the system then generates a trade without the interference or application of a human mind. That's as simple as it is. Uh, these models can be as simple as crossover models or of moving averages, or using MACD to create generate trades, or using Bollinger Bands, etc. Uh, Again, we'll be exploring this a little ahead. We'll be discussing it a little further, but that is basically what I wanted to get across. It's not too complicated. Algo trading sounds as if you need a lot of knowledge of coding, etc., but there are softwares which make it a lot simpler. We'll be discussing that also ahead. Now, what are the types of algo trading that are there in the market? Well, basically, I classify algo trading into two parts. One is high frequency trading, which is also known as HFT, and the other one is the non-HFT part. HFT trading is basically used by institutions. It is and large broking houses. It involves parking your servers right at the exchange, thus allowing them to get data, or rather the market movements, in microseconds. It moves the speed of the data is very fast, allowing the users to generate buy and sell trades based on this data, and allowing them to generate small profits uh, through multiple and a very large number of trades, which over a period of time amounts to a significant profit. This is usually done by the institutional clients, because it involves a pretty significant cost to park your servers and have those strategies allocated to your having your various trading strategies allocated to your servers. The second is a non-HFT type, which is basically which are used by various individuals and fund managers who are not into HFT, shall we say. This basically is what I was talking about earlier, where people to create their basic trading strategies, code it, and allow the model to run on a fully automated basis. What are the advantages of algo trading? Well, there are many, as they're listed out here. Uh, you know, trades are executed very quickly at the best possible prices. Since the trade order, what is to be generated, is already built into the algo, so there is no fat finger errors happening. Um, you can simultaneously trade on multiple check on multiple market conditions, and that is actually one of the most important advantages of this, because what happens is that most people do not just trade on one market. Most traders do not trade on one market. They might be trading on Nifty, Bank Nifty, a few commodities, for example crude oil or gold, silver, etc. Now if a person has a strategy in place which he looks to apply to across all these markets, right? He might be starting it these markets at a 5 minute interval chart, a 10-minute interval chart, 15-minute interval chart, and other combinations. Now that's a huge number of combinations that come up, and application of human mind, at sometimes something can be skipped, or you might be studying some other chart when the signals come up in another one. So these are the kind of limitations of human trading that are there. But when you're trading using an algo, this limitation is not there at all, because the algo is simultaneously checking all these market for that specific strategy, and in whichever market the right strategy comes up, or rather the strategy is available, is applicable, the trades will be thrown in that market. The second most important, as per me, is the ability to backtest your strategy. See, understand this. You might have been, you might have come up with a strategy and been trading in the market for the past 3 to 4 months with phenomenal returns. But frankly, 3 to 4 months is not that big a time. You might just be lucky, or the market might just be going your way. Uh, and you don't have to agree with me on this, but that's my personal belief. So, if you are, if you want to really understand how good your strategy is, what you can basically do is create the code about it and backtest it historically, and you can backtest it. Backtesting is basically checking the strategy over historical data, and just understanding how the strategy would have performed in various markets. For example, if you're checking over the last 5 to 7 years, you would have had a bull market, a bear market, some crashes during really bad times, and you would exactly know how your strategy is doing. And then if the results still hold true in backtesting, then you know that your strategy is good and it's worth trading. If not, then that doesn't mean you stop trading your strategy. You just look to see how you can make it better. And The other one is this one: reduce possibility of mistakes by human traders based on emotional and psychological factors. uh, See, for me, trading has always been very, I mean, I get too involved in it, I get too emotional about my trades, and there's always a psychological factor. For example, you know I used to, or have a bias on the market. For example, if the RBI is going to be coming out with rates, and I expect the market to be reacting badly for that, and my strategy, or a strategy with me, is saying that we should go long. So my own fear, or my bias with regards to the market, would mean that I would not take that trade. So I would ignore what the signals were being thrown by my strategy. I'm not debating whether it is right or wrong. It could, the markets could go either way, but I did not rely on data, but on my own bias. Second is that people get very emotional about trading. I've seen people cut profitable trades quickly and take small profits, whereas they carry forward their losses, because rather, I mean, they cannot accept the fact that they were wrong, or they cannot accept the fact that you've got to book a loss. In algos, none of this is there. There's a software, you've got a stop losses, that person will execute the stop loss, the algo will execute the stop loss irrespective. It is not going to be there are going to be no emotional factors where it might just say that the markets will perform better tomorrow, so let's just keep this trade now. It will perform only on the basis of data. So these are the three most important parts of what I feel is algo trading really helps a trader. Now, what are the kind of trading strategies that are there? Well, there is a trend following strategy. This is actually something that I'll be discussing in detail, because this is the kind of strategy that I'm trading, and I have a lot of experience with this. I feel that this is also a strategy that is used by a lot of commodity trading advisors, also known as CTAs abroad, and it basically involves various kind of crossovers, channel breakouts, I mean, basically it's done only on basis of technical indicators, on the basis of which it is the algo decides whether it is the markets are going up or going down. And if it is going up, it will just follow until the trend changes, and if the trend changes down, then it will go short and it will follow the trend. The second is the others are like arbitrage and jobbing. Now, I would not look to explain arbitrage and jobbing, because as per me, it is not possible for individuals to do this, because these are usually done in HFT trading, and the institutions have got it cornered, and the ultra HNIs, because arbitrage and jobbing are something that can be done phenomenally well on HFT servers, and the individuals just do not get a chance to to make significant profit out of that. I'm not looking to debate. I know some people who really feel that they are still getting very good returns, but that's my personal opinion. Mathematical model. There are a lot of mathematical models that are there in the market, especially like a delta neutral strategy is a very popular one amongst traders. It basically involves options, and it is also the strategy that was being traded by my company to generate some phenomenal returns for their company. For the clients. But that is something that I have not followed too closely because I do not have backtesting data for options. And then we have mean reversion. Mean reversion is another form of trend following, but it is based on the philosophy that highs and lows are aberrations, and sooner or later the stock will come back to its mean. These strategies have been working. I mean, lately have shown great results abroad. A lot of people are swearing by it. Me personally, I have not, I've been not able to develop a very good mean reversion model, and the results are just not good enough for me to say that mean reversion is applicable today, but or to the Indian markets. But there are traders who are there who are making good returns. So again, this is not a debate. This is my personal opinion. Now, how to algo trade? See, basically, there are three paths to algo trading. You require data feed, wherein the live data comes in into your software. So basically, the live data comes into a trading software where your entire technical analysis is being done. And once the data allows, throws up, creates a pattern on which a trade needs to be executed, the trade is generated through this software, and then this trade is thrown into another software which is basically linked to the exchanges, so that the trade can be executed in the exchange, be a long or a short. So these are the basic, a broad breakup of what are the three things required. Now, which are the trading softwares which are there at the moment? Well, there is Symphony, Presto. They basically have their own data. They provide their own data feed also, and they have their own coding software. You can code in Presto. It's a phenomenal software. I'm using that for my trading. I'll get into that a little later, and it also allows trade execution through them. Similarly, you've got Zerodha Pi. It's about Zerodha Broker. It's a reasonably good software. There are some of my friends who are trading using this, and they are quite happy with it. Then there are other softwares like AmiBroker and MetaTrader. These are basically desktop softwares. You can create various analytical charts using them, and then you have got you've basically got bridges that are given. So basically, the trading is the trades are generated using AmiBroker, and the bridge is used to send the trades to the trading software. To the exchange software. So basically, I'll be talking more about AmiBroker because that is the software that I'm using, and all the further videos that I'm going to be posting out here are going to be AmiBroker based. I'm going to tell about how to create various strategies in AmiBroker, of how to utilize AmiBroker to create strategies and how it basically works, etc. I've been using AmiBroker to generate the trades for my personal algo trading strategy. What are the requirements? Well, basically, you require a computer, you require some trading knowledge, which I would be giving, and hopefully that would be sufficient. Internet connectivity, access to market data, not really at the moment. You don't require live market feed, but what you definitely need are historical data for backtesting, and I'll be sharing a few links from where you can download the historical data base for backtesting your various strategies, be it Nifty, Bank Nifty, maybe a couple of commodities like crude or gold. So we'll get, and obviously we'll be getting that into later also. So that's all about it. That's the end of our presentation. I hope you found it informative, and you know, I hope to see you in further videos. Thanks.